Happy New Year and welcome to Tailored Talent. My name is Eric Walzakowski, CEO of Bespoke Partners and host of Tailored Talent. Today, I'm joined by our Chief Marketing Officer, Adam Boone, as we talk about quick look back to 2024 and trends we expect for 2025. Boone, Happy New Year.
Happy New Year to you, Eric. Thanks for having me on.
Did you have nice holidays?
Wonderful holidays, very relaxing, but man, we got a head of steam coming into this new year. Things are really exciting.
Well, I hope you got some rest because it is going to be a busy 2025 for sure. Hey, Boone,
Yep.
So before we dive into 2025, let's take a quick look back into 2024, and maybe we'll look at kind of the macro market trends, private equity deals, and then of course the impact it had on talent. So let's dive in first to the macroeconomic trends that we saw in 2024. I think point number one and the biggest piece was the election, wouldn't you say?
Oh, yeah, absolutely, 1000%. I think everybody knows that there was a whole lot of people holding their breath in pretty much every sector about wondering what was going to be happening with the election. And, right up until the end, it was just a lot of uncertainty, and people weren't able to really necessarily place bets that they were going to be confident in. And so, yes, I think that a resolution to that, one direction or the other, absolutely was met with some relief across all sectors. And same, of course, true with the monetary policy and the drop in the interest rates.
No doubt. And I think that uncertainty really impacted private equity deals because folks were trying to figure out, again, as you said, one way or another, what the monetary policy was going to look like so that they could price deals that, of course, they could get a return on in 3 to 5 years. And of course, now that we have the election settled, one way or the other, we do have a monetary policy that we're going to be looking at. The other thing that I thought was quite interesting in a macro trend was there was a glimmer of hope in the IPO market.
Yeah, absolutely. I mean, ServiceTitan, their IPO in December, really nice pop. And I think that gave an awful lot of hope. We'd seen some glimmers of it earlier in the year, like with Astera Labs and other firms that came out with pretty strong IPOs. But I think ServiceTitan, a lot of people are using that as the bellwether, looking at potentially how things could really start to open up in terms of IPOs in this year, in 2025. I think overall we saw a 36% increase in IPO activity. So very good sign of one of the most important exit avenues, of course, for private equity.
No doubt. And I think, again, with the view on monetary policy, interest rates coming down, that glimmer of hope may actually turn into some kindling that could start a fire in 25 for sure. As we look at PE deals and particularly software, I think the value was up, but the number of deals was down.
It's interesting. We track deal flow as one of the chief drivers of talent, right? Talent, new search starts and everything always are largely associated with deal flow. And what we saw in 2024 is that deal flow in terms of count came in, just over 6,000. And that is actually kind of a reversion to the mean, if you will. Prior to the big giant surge in 2021 and 2022, where there was just tons of capital flowing into PE deals. The average was right around that 6,000 count, and so we've actually had sort of a reversion to the mean, if you will. But yes, what your point is that we're seeing some very much larger average deal size, I think overall, and definitely a surge in the mega deals.
Yeah, Boone. So you mentioned mega deals, and it's interesting if you actually zoom out and look at the macro trends, we shouldn't be surprised that there were mega deals. IPO market was depressed, so the public markets weren't available for these assets. You look at the amount of money that's gone into private equity and dry powder sitting on the sidelines. Doing bigger deals allows you to put more money to work. And then the other thing is you have a much more mature software industry. So you have larger and larger companies. And so when you look at the mega deals, not shocking. And candidly, that's probably another thing as we look into 25 might be an interesting topic to dive into.
It is, absolutely. I think part of the overall justification or the profile there is the idea that you maybe have a better shot at managing your risk when you're doing a much larger deal that way. Even though, counterintuitively, you're putting a lot more money into the bet, if you will. The idea is that you're going after a much more mature company, and there may be opportunities for optimization, financial engineering, and other ways to create value, right? And so it ends up being perhaps more in control than, say, smaller, earlier stage type of deals that, the late venture growth equity stage deals that often are characterizing those smaller companies.
Now, I think one of the keys to that, and I think that's another reason why we saw mega deals, because I don't think we saw as many strategic acquisitions in 2024, but they're going to be two keys, I think, to return capital on those mega deals. I think you're either going to have a very robust public market, and you're also going to have strategic buyers at the table, because when you think about a 3 to 4x on a mega deal, that's a pretty large swing for another private equity firm to take that out if in fact they do at that point. So it's going to be interesting to see folks generate returns on those mega deals for sure.
I just all the way around. I mean, we need to see M&A and the return of M&A as a potential way of doing both, of course, exits, but then also allowing roll-ups and platform add-ons and everything to reach the level that will really put the capital to work. So fully agree.
No doubt. Another interesting trend we saw in 2024 was venture capital participating in what historically has been growth equity. Boone, what would you make of that?
Yeah, it's interesting. I characterize this as sort of a factor of two things. The VCs in some ways are swimming upstream and getting into growth equity or even into buyout level type PE type deals. Part of this, I think, extends from the fact that they're actually having to follow some portfolio companies or at least sectors later into their maturity. So it's not that sort of traditional VC model where you're investing, placing a bet, and you know that 9 of those bets are going to fail and one's going to be a huge success that'll make up for all of it. But instead, you're kind of following through and maturing these market segments and the new entrants, so that at the end of the day, you're able to achieve an exit that way. The other part of it, of course, is that the different models of investment vehicle, whether you're investing as a portion of ownership or you're doing a full buyout, these have to do with control and ultimately how much you can shape the outcome and where that company is ultimately going. And so we've seen a lot of interest there. Just doing a year-on-year measurement, the deals that we track in prior years, it was around 4% in terms of overall VC deals that were in that sort of growth equity or later stage. That doubled in toward the end of 2024 to 8%. So quite a notable change there.
No doubt. And once again, I think the macro market trends played a lot into that, right? The lack of liquidity in VC, the need for returns, making some of these later stage assets more attractive so that they were shorter to exit. What was interesting is obviously the most interesting or notable deal was the Databricks deal that certainly set a record, raising $9.5 billion at a $60 billion valuation. That was quite remarkable.
Definitely quite remarkable. And of course, Databricks is one of those candidates for IPO that everybody's always talking about. They had this just mammoth raise, and people are saying that's going to be setting the stage for them to, go public at some point, whether it's this year or next year. Of course, no one knows for sure, but it's a very interesting opportunity there. But your point about exits is just absolutely spot on, and the need for the traditional exit avenues to come back or at least get something close to what they used to be. PitchBook was estimating the full year 24 exit rate at fewer than 800 total exits in PE. And that compares to the typical annual average of 900. So we're still very depressed in terms of overall exit rate.
Well, it certainly creates a problem for all of private equity, as we've talked about many times on this show, portfolio company bloat, where PE firms have 25 to 33% more portfolio companies on the books than they're used to supporting. And so those exits are really important. That said, we did see a glimmer of hope in Q3. One of our favorite firms, Thoma Bravo, had two very nice exits, one in Instructure, which sold to KKR for $4.8 billion, and Venafi, which sold to CyberArk for $1.5 billion. So it was nice to see those exits, although as we headed into Q4, we didn't see the momentum continue. There was a brief pause in that pickup in exits that we looked at.
Yeah, no doubt. And I'll just mention, we're just delighted when companies like that are able to achieve exit and have, a team of executives that we've been part of building and placing there. It's just immensely gratifying to us. And at the end of the day, that's what our job is to help these companies achieve the right exit and achieve the investment thesis for their investors. We don't stop at just the placement of the executive. Our long-term goal is to make sure we help them achieve exit. So just
it's pretty cool. In the Instructure deal, I think we placed 8 executives there, and of course in Venafi we placed a very important CEO there that helped them get to exit. So as we think about the macro trends, private equity trends, how did that impact the talent market in 2024?
Yeah, massive impacts in a variety of different ways. So, number one, first and foremost, go-to-market leadership turnover and go-to-market leadership was really part of the whole up-leveling effort that PE firms were pursuing. As I mentioned earlier, deal flow is often the chief driver of turnover in these executives and new search starts in these executive roles. But as they're looking at having to hold these portfolio companies longer, and as they're considering whether or not they have the right team in place to really grow and achieve the investment thesis over that long haul, often they look first at the go-to-market roles, the CMOs, the CROs, the CCSOs, and that leads to a very big spike in turnover there. Similarly, CEOs also are under scrutiny, especially as maybe the portfolio companies get a little long in the tooth. And it really any other role that's focused on operational efficiency. And this all stems from that need for capital efficient growth, right? The ability to grow both the top line revenue and the bottom line profits at the same time and grow profitably. And I also say that this is another reason we think that a lot of VCs are starting to look at sort of those growth equity deals and later stage deals, because they're seeing that if they can bring in the right talent to grow these things efficiently, that in the end can lead to a much stronger exit for them. So really,
so I think 2024 we look at capital efficient growth and executives that know how to do that, and then others that know how to smell the exit in terms of positioning the company for exit. And I think we saw that in our CEO placements, folks that have a track record of exiting companies. But then we also saw the rise of the COO, particularly in our larger companies, for PE firms that were looking for that operational efficiency for a CEO or a COO to come in and support the CEO in terms of optimizing the organization for that exit. How did these turnover effects impact executive compensation in 2024?
Well, number one, it's been a tight market, and it has been a tight market for talent for private equity firms really since 2021 is kind of when the tight market really took off, and it's remained tight and very much a candidate's market in that sense for quite some time. Supply and demand tells you what that means is that compensation levels are going to be elevated, and they have remained elevated. They passed the $500,000 OTE mark a couple of years ago, and it's remained there. I think the average now is running about 522 for C-suite executives, 522K for C-suite executives because of that. And equity is very close to 16x OTE multiple across the C-suite, which again is quite elevated. I'll also note that the estimated value of equity has gone up over the past 12 months. And that is partly, I think, optimism because of the expectation of better exit outcomes that people are anticipating. So that's also a good sign in where the market may be going.
No, fantastic. So I think if we look back at 2024, some cool tea leaves came out of it. I mean, we know who our government's going to be that's going to be setting policy. Barring a catastrophic event, I think interest rates have peaked and are now slightly on the decline. We look at the private equity environment, still too many companies being supported by portfolio or by PE teams. But that said, I think we started to see some exits. Ton of dry powder sitting on the sidelines. The market for talent has been extremely tight. I think a focus on capital efficient growth. Executive compensations hit an all-time high. So that really sets the stage for 2025 and what's going to happen. I think we'd all love to know. So Boone, maybe we start again with the macro economic trends. What are you thinking about the geopolitical environment?
Yeah. So, our work tends to be in the United States and focused on companies that are based in the United States. But, it really is a global market. When you're talking about software and SaaS, many of these companies and the clients we serve are actually have many geographic areas that they serve and regions that they focus. And so in particular, software and SaaS is truly a global market in most cases. And talent mobility across the global market is sort of the question there. One of the interesting trends and things that we were brought into in 2024 was this move of a lot of companies in Europe looking to get a foothold in the United States and open that market for themselves. And then the reverse. So companies that are based in the United States looking to get a foothold in Europe and make that their sort of geo expansion strategy. And I expect that to just, grow from this point on. We see lots and lots of opportunity and business environment that perhaps is a little bit different in each one of those geos. But the bottom line is, as Mark Andreessen famously said, software is eating the world. That means that pretty much every company in every sector, in any industry, is adopting software, is adopting SaaS, and streamlining their operations and using that as an engine for growth, and pretty much just everywhere. And so I don't expect that to slow down at all. And yes, there's geopolitical uncertainty, and that will certainly affect certain market segments or certain geos, but I believe that the broader trend is clear that this is going to continue to accelerate.
No doubt. So software is going to eat the world. So software is continuing to globalize. It's continuing to spread across industry. Old line industries are taking on tech as kind of a catalyst for change. So we're seeing that. But back to the political environment, I still think while we know who the administration is, there's still some questions and some kind of hold your breath moments around, okay, what's going to happen in the next 120 to 150 days as the administration takes hold? I mean, I think there's optimism, no doubt, that some things are going to change and get cleaned up, but I still think there's a little bit of uncertainty. Wouldn't you agree, Boone?
Oh, without a doubt. I mean, one of the things that's talked about an awful lot in a number of the media that I consume is what's going to happen with M&A and what will be the catalyst that puts a lot of this dry powder to work that is out there. And there's, with the change in administration and Lena Khan out as chair of the FTC, the FTC, rightly or wrongly, was getting an awful lot of criticism and scrutiny as sort of making a chilling effect around M&A in this country because of how those policies were being implemented and such. And Lena Khan being out at the FTC created this expectation that perhaps now we're going to see some of that loosening and perhaps being a little more favorable to M&A. And so that could be, what causes the dam to break and a lot of this dry powder to be put to work. But again, these are kind of reading tea leaves, and no one has a perfect crystal ball.
No, bit of optimism there. But the other side of M&A is really the cost of capital and monetary policy. And while I think cost of capital has hit the peak, so we can now price this, I still think there's also some uncertainty around the rates, how low they might go in 2025.
Yes, without a doubt. I mean, with the last rate cut in December, the Fed signaled that they were not going to be as aggressive with cuts here in 2025. And so that, of course, had some ripple effect and concern in the market overall. But again, it's just next to impossible this early in a year to predict what that's ultimately how it's going to play out over the rest of the year, right? And so there's certainly some uncertainty there. And, ultimately, what all this boils down to from the PE context is where do we go with exits and what's going to happen with exits? Because at the end of the day, as you said, it's this portfolio bloat and ultimately being able to liquidate and return some of the investment back to the LPs and such. That's the playbook, right? That's the formula. So at the end of the day, if the IPO market does indeed come back as we're predicting, if Databricks, if OpenAI, others like that are able to achieve IPO, well, that in turn could end up having a good ripple effect that likewise could open up some of the floodgates and allow that dry powder to be put to work. So again, lots of uncertainty there, but potentially good signs.
Well, and I think as I look at 2025, I do think we're going to see a rebound in the IPO market, particularly as you think about dry powder sitting on the sidelines. I think the cost of capital reaching its peak, even though I think we're going to still see some volatility in the debt market. But I think the big driving force behind that is we have some quality companies that are on the brink of going out, whether that be Databricks, OpenAI, Cerebras Systems, and others. And I think once that gets going, I think we're going to start to see that move forward. The other area of interest, I think, as you think about IPOs, really relates to AI and Fintech. Wouldn't you agree?
Oh, yeah, 1,000%. I mean, we've seen that pretty much everything that moved in venture over the past 18 months to 2 years has been somehow related to AI or some aspect of Fintech, whether it's, payments or other ways of optimizing financial transactions or marketplaces related to that. I mean, that's been driving so much of the interest. But without a doubt, I believe those are going to be the companies that ultimately are going to help us break that IPO logjam.
100%. And then the other thing that really feeds the IPO market is the strength of the equity market. And I think that, look, we've seen some new record highs in the public markets and where things are going. So you add on to that, as well as PE portfolios that are a bit long in the tooth needing exits. I think we could see just a robust and dynamic IPO market for 2025.
100%. I mean, it's options, right? They need options. PE firms need options for how to bring their firms to exit, whether it's the IPOs and a rekindling of the IPO market, whether it's exits to other sponsors, or whether it's exits to strategics, right? And roll-ups and add-ons and that sort of thing. So, and what we've seen, and I think all the data really bears this out, is that gap between the valuation gap has narrowed enough that probably some of that stuff is going to start to move and start to get done. The stuff that was in sort of the vapor lock for the past 2 years.
No doubt. And I think, we're slowly shifting into what does this mean for the PE environment? And of course, number one is folks need exits. So we talked about the IPO market opening up for these exits. You mentioned, Lena Khan, in a more favorable environment for M&A transactions, which is also good for exits. What else from your perspective, Boone, is feeding M&A exits for private equity in 2025?
Yeah, well, number one, there is a definite need for consolidation in some of these market segments. We track very granularly 28 different software subsegments. We have analysts who spend all day, every day, just going super deep on what's going on in those segments in terms of what the funding events are, what sort of M&A prospects are happening, but of course also getting really deep on the candidates and the potential executives who could be available for other assignments at some point. So we're going super, super deep on that. And without a doubt, I would say in at least half of the segments that we cover, there's a pressing need for consolidation. There are just an awful lot of companies, some of which are not going to make it in the long run, or are not able to grow with that sort of capital efficient growth strategy. And so at the end of the day, they need to be part of a roll-up strategy. They need to be an add-on, or ultimately they need to find other ways to grow in combination with another company. So there's a pressing need there. There also, of course, is just immense pressure to put this dry powder to work, right? We've seen, this extended period with some of the funds getting very long in the tooth, and the need to start putting that dry powder to work. And, that is just, and of course, the pressure to start to return to LPs some of the investment and generate that sort of liquidity. All that adds up to an environment where M&A is going to have to start to happen. The question is when and what will be the trigger that really starts to make it take off.
No doubt. And so again, looking back at exits, IPOs, M&A from strategics, so strong equity market, favorable political policy. And then I think you really touched on, which I think we're going to continue to see, is sponsor to sponsor deals where one sponsor took a firm to a certain level and now they're going to sell to another firm or collection of firms. The other piece is I think mega deals are here to stay. Wouldn't you agree?
Oh, without a doubt. I mean, for all the factors that we described earlier, number one, a mega deal is often a way to kind of decrease a certain amount of risk of a certain type. We also see, more crowding into the lower end of the market with VCs swimming upstream. And so what that means is there's more competition for the deals down there in the lower middle market. And so that in turn means, well, you start to figure out ways to put the capital to work in some of those larger mega deals. So that certainly makes sense.
Yeah, and we talked about dry powder, Boone. I mean, did you see the stat in 2015? There was 1 trillion available in dry powder. In 2024, there's over 4 trillion in private equity dry powder sitting on the sidelines. So you would argue that definitely some deals need to get done. So let's talk about new deals and place where folks are going to put money to work. I think we would both agree that we're going to see a robust deal environment in 2025 because of the dry powder, stabilization of the interest rates, and increased demand for digital transformation and software-driven efficiencies in portfolio companies. But what specific sectors do you see interesting? As you mentioned, we cover over 27 subsectors. So what's your team telling you about what subsectors are going to be hot in 2025?
Yeah, definitely. Really, some fascinating activity going on in these sectors. So two that are absolutely front of mind and that we're seeing as having a lot of potential activity. One is Fintech, as we mentioned earlier, and these will be payment platforms. They'll be streamlining financial services and automating key steps in financial services, and then of course the integration of blockchain and really what are the sort of the Bitcoin type technologies that allow transactions and records to be maintained and distributed all the way around. Those add up to Fintech having an awful lot of potential for some consolidation, but also some really interesting new deals potentially, and also some exits. Close on the heels of that, of course, is artificial intelligence, like AI. We've seen so much venture flow into AI that now in PE, there's clearly going to be some of those companies that are going to matriculate into the sort of PE and the growth equity type stages. And so there's tons of potential for that in deals there. Other areas are cybersecurity. So, cybersecurity has really taken off over the last couple of decades, from what was a pretty sleepy, geeky IT backwater into something that is now really mission critical as digitization has taken hold across pretty much every sector. Well, digitization and records and transactions and user data all needs to be protected. And cybersecurity ultimately will, I'm sure, be maturing in one of the areas we see the potential for an awful lot of activity of PE investments. Healthcare. Health tech, healthcare IT, all the way around. It's also one of the most active that we anticipate. Just in general, ways to streamline and drive some cost out of our healthcare system and create efficiencies that can help keep some costs contained within healthcare. Those are front and center, front of mind for an awful lot of people out there. And I think that PE is going to be seeing wonderful opportunities to take some of those companies and really lift them up.
No doubt, Boone, and for our organization, it truly is game changing to have an analyst covering these subsectors, and really gives us the opportunity to have a look and see that AI, cybersecurity, fintech, and healthcare are really going to be hot areas for 2025. The other thing we talked about is venture capital's participation in growth equity deals. Do you see that continuing as well?
I do anticipate that will continue. I think that there's a model there, and I think that we've also seen, there's been some recent media coverage in the New York Times and elsewhere about venture firms and sort of the changing face of venture. And part of this, I think, has to do with the basic model of investing that they pursue and how maybe it's maturing or they're finding new avenues to put money to work. The old model, the model I grew up with when I was doing venture-backed startups was, they place 10 bets on 10 different companies and they know 9 of those are going to fail. And the one that makes it is the one that makes up for it all. Well, I think now perhaps there's a slightly different risk profile that a lot of venture firms are considering and are looking at, which looks much more like the, say, traditional PE type model. And we know that from quite a few of the traditionally venture-oriented firms that work with us, that their interest is in capital efficient growth. That's very, very different from the traditional VC model, which was once you've introduced a new technology, is just grow at all costs, right? It's a land grab. You just are investing growth no matter what it takes, and you just worry about profit later, right down the road. That's somebody else's worry. Well, we're seeing a change, and that there are firms that traditionally would invest that way that are now looking at it and saying, no, what if we grow in a more capital efficient way? So that is another part of the trend I think is going to drive this continued interest in VCs and swimming upstream to PE.
No doubt. I couldn't agree with you more. And so, you mentioned a little bit about this strong demand for executives with experience in profitable growth and operational efficiency. So I think you and I both can agree as we kind of move into what does this mean for private equity talent? That's going to continue to be a trend in 2025 is this focus on profitable growth. What else would you see as a trend for PE talent in 2025?
Yeah. So yes, profitable growth, figuring out ways to do operational efficiency, application of new technologies, and especially AI and the way it can be used to automate key steps. We've been seeing we have an analyst who covers the AI and ML sector for us, and what we've been seeing is that in fact the executives that we know in that sector are actually in high demand in every other sector, right? Because AI, well, yes, it's obviously vibrant and growing and rapidly innovating as a sector itself. How that technology is used elsewhere and how it ramps the operational capacity elsewhere is what is key and what is driving an awful lot of interest in these executives. So I expect that will happen. I expect we'll continue to see elevated compensation packages. The OTE for executives will continue to be elevated. It's a tight market. And if the market comes roaring back the way we expect, meaning the capital starts getting put to work, the exits start to unlock, and so on, we're gonna actually see that tight market get even tighter. That's what I predict potentially could happen.
No doubt. I mean, we've talked about this all the time that we play in an extremely tight market because our clients demand the best of the best proven executives. And I think as that deal flow picks up, exits happen. So the good side of the exits is it's going to create that natural churn in executives. So people are going to be available. But as new companies starts and new investments go to work, the demand for the number of folks is going to increase significantly, which is going to put some pressure on roles that typically turn over in the first 12 months, the CEO and the CFO primarily. Yes. I anticipate those are going to be very tight markets in 2025. But then I also think we're going to continue to see pressure on the go-to-market function and the growth leaders. Wouldn't you agree?
100%. Yes. It is the case that typically go-to-market leaders like myself, we have the lifespan of fruit flies. Typically 18 months in role is about what we can expect, because if we're not working out, well, it's one of the first things that you want to change over and try and find an executive who's going to be a better fit for that particular company. And I'm joking about it, but in fact, it is the what I'd say is a functional area, the one that turns over the most. And It's because they're so close. We're so close to revenue, and we're so close to figuring out how to capture that revenue and how to compete and such, which of course is mission critical to any growth strategy. So
no doubt. And so with all these new investments, this turnover, the active market, it's also going to put pressure on companies retaining their key executives, because boy, with all of these new investments this year, it's going to be very tempting for these folks to jump on the new thing that's going to allow them to kind of see the next rise of the market.
If I were planning my talent program, looking at this year and next year into 26, if I were planning what I was going to be needing to worry about or be concerned about with what I was funding, it would be that retention and looking at how I was going to be, trying to keep my top performers and that sort of thing. Because if, again, sort of crystal ball here, if what we're talking about of the market tailwinds start to pick up overall for PE, well, we could start to see a spike in demand and a tightening of the market like we saw, back in 2021, 2022.
Well, and I think as you and I have, talked about over the holidays, cautiously optimistic. We're cautiously optimistic about 2025. There are a lot of factors that are going to suggest that PE volume of transactions going to pick up. But Boone, give it to me. If it does explode again and it picks up and people put the 4 trillion of dry powder to work, what's going to happen? What does that mean for the talent market?
Yeah. I love this because, it's one of those things that we know will happen someday. It's just really hard to figure out exactly when. So what I like to do is I like to look back at the PE investment surge of 2021 and 2022, and then really study how that affected the talent market, right, for PE and PE portfolio companies. Because I think what it can do is give us a snapshot of what could happen, right? So rewind, back in 2021, PE investments, according to PitchBook, reached almost 10,000 deals, right? So
10,000 deals. So we're at 6,000 now.
Right. So you look at that, it's a 60% increase in deal flow. And it was, by the way, you look back over 2018, 2019, 2020, that was right around the 6,000 deal mark in terms of the deal count. So yes, you saw in 1 year a 60% surge in deals, and that continued on into the first half of 2022. So yes, massive influx of capital, tons of deals being done. Well, what's that mean, right, for talent? Well, talent is a market. And just like any other market, when you have deal flow being the number one driver of new searches, as that goes up, as demand goes up, well, you start having scarcity on the supply side, meaning the executives, and there are a couple interesting ways to measure this and track this. So one is search starts, right? So industry data shows that during that period of the surge in deals, that search starts in private equity firms more than doubled in that period. And our own search starts during that period more than doubled. In fact, we did better than the industry average.
Well, and at that point, we were turning away a significant amount of work because we focus intimately on quality. And so we did not tax our system. We only took on searches we could do. And so again, when you look at the search starts doubling, it's a really interesting time in the market.
Very interesting time in the market. And it's also going to be interesting to see how the search firms would respond to that. Because like you said, for us, it was critically important that we never are going to, do what I call a half-assed job on a search for a client, right? Where we were just stretched too thin and having to try and cover a client's work with the less than ideal team and staffing it. So, it's very interesting to see how search firms will manage that capacity, that sort of thing. But, a couple of things that we saw during that period, right? Number one, a lot of firms were in the market for that key sort of talent, like we were talking about earlier, that often follows a new deal. So CEOs, finance leaders, go-to-market roles were very, very high in terms of the number of search starts that happened. So of
course you have demand up, supply low. What happens, Boone?
What happens? Price goes crazy, right? Yeah, exactly. It's a seller's market, and in this market, the candidates are the sellers, right? They're selling their services to the private equity portfolio companies. So the candidates were in the driver's seat, and that means big upward pricing pressure. In this case, the OTE comp going up, and this is where we saw the average OTE comp for C-suite surging past that $500,000 mark, which was around a 20% bump from the previous period, right? So that period prior to the big market surge, we saw a 20% bump, and it has not gone back down. And we do not anticipate that it will. It has stayed above that benchmark, even though overall deal flow has fallen off from that peak. And that's just because elite executives and those who have done a really good job during that surge are always going to be in demand. So it has been a tight market. It will continue to be tight in that sense.
So demand up, supply tight, compensation up. How did that impact days to close during that period?
Yeah, right. So we track days to close because, of course, it's an indication of how loose or tight a market is and how difficult it is going to be to solve a certain search. Now, I will say that this is the data that I'm going to share here comes from some industry sources, and in particular, the firm Thrive, which releases its data on the days to close and search starts and other things. Now, they reported that during that period of the 2021-2022 surge, that the average days to close for PE searches was around 200 days, right?
Whoa,
and
200 days.
Yeah, and that's the average, right? And that's doubled the previous level approximately for those firms.
Boone, I don't remember us closing searches in 200 days, though.
No, we were far, far, far less than that. In fact,
I want to say we were 91, 92, 93.
Less than 100 is our average, and it remained that even then, again, because of our dedication to our clients and the fact that
focus. Software all day, every day. Functional focus.
Yep. And we go deep on those functional roles. I like to say we can recruit the unrecruitable, right? Is one of the things that we
I think, look, the greatest test to that is, and it was interesting, I was talking to a PE firm recently that they have their own internal recruiting folks, right? So this is a top quartile PE firm, has their own recruiting folks calling on people. And I said to them, what's your conversion rate? So of the people you call, what's the percentage that return the call, get on the phone and have a meaningful conversation? They said 75%. Boone, ours is 82%.
Yep.
So we are better than the principals, while what we see across the industry is that conversion rate is 50 to 55%, and we're at 82%. And I think that really speaks to focus industry, focus function, which results in better results.
100%. The candidates take our calls. They take our calls. When they see Bespoke partners on the caller ID, they answer. And the reason they do that is because they know we're not going to waste their time. Our recruiters, our partners truly understand where these people want to go in their careers. They truly understand what is going to be a fit for them. We do not waste their time. They when we bring them an opportunity, we know it's because it's a fit with where they've been in their career to that point, and that we believe it will be a fit for where they want to take their career at the next step, the next assignment. And so they absolutely take our calls. And that I'm not aware of anyone else who can post an engagement rate like that, 82%. It's just unheard of.
No doubt. So just back to the increase in demand, tight supply, compensation up, days to close expanding. How does that impact the talent?
Yeah. I mean, just during that period of the big surge, right? It was not uncommon for candidates to have 3-4 offers in hand, right, on the table that they were picking from, right? It was very much a candidate's market, very much a seller's market in that sense. And so, that sort of interview to offer ratio that we track, we saw that did normalize a bit, but it still remains elevated for that elite talent out there. Acceptance rates Acceptance rates to offers declined dramatically during 2022. Again, they can only take one job, and if they've got 4 offers on the table, then that means 3 of them are going to be losers, right? So there's that. The pipeline metrics for a given search, just being able to find candidates who are willing to make the jump for most search firms out there was very, very difficult and very hard. We came in and had to clean up an awful lot of searches for other firms where other firms had just not been able to make an even reasonable pipeline for a given role. And we've been brought in many, many times for that. And then, as already mentioned, retention strategies. Retention became critically important throughout that period for all types of companies, but especially in the software sector.
No doubt. So that impact on talent, candidates are going to have more offers, acceptance rate's going to go down, pipeline metrics aren't going to look the same. And when you get to that final slate, it's going to be compressed. You're going to have retention challenges. So what does that mean for PE today? And if I'm a PE firm that's looking to do a lot of deals in 2025, how do I get ahead of the market?
Yeah, it's a great question. I mean, getting ahead of the market means starting today. If you've got a portfolio company you're holding and you even have an inkling that you want to make a change with any executives, don't wait, because if M&A comes back and deal flow comes back and exits come, roaring back the way that everybody's predicting they will, your searches are just going to get harder and the market's just going to get tighter. That's the key, is get into the market today. And along with that, consider your talent during due diligence is another aspect of this, that some of the best clients and the most effective clients that have, the greatest outcomes, we see them doing this during due diligence. We offer mapping services where we can help you to understand what the talent market looks like with a market map that you can use during due diligence to really understand, okay, this firm here we're considering may need help in go-to-market. Who's available? Who potentially could be available? And again, because of our engagement rate, we have a better perspective and more clarity on who's going to be coming online and putting their head up and ready for a new assignment than anybody else in the industry. So that's the other part, is I suggest they be doing that during due diligence. What else should they be doing? They should be working with specialists like us, right? We did insulate our clients from the worst of the tight market impacts, especially when that big surge happened. And again, it's because we are tuning our capacity to their needs. At times we've had to turn away business because we knew it was going to overstretch our team and not allow us to give that truly bespoke white glove service that our clients need in order to really get the talent in seat that they need. And it's also
it's quite interesting, Boone, when you talk about working with specialists. I often laugh at this industry because generalists are the flavor of the day. And when I think about the similarities to healthcare, and I think about, I have a general practitioner, I have my doc that kind of manages my overall health. But yet, when I need heart surgery, I'm going to go to the heart surgeon, the specialist, the person that is going to guarantee the results. I'm not going to hire my generalist to do my heart surgery. But yet in search, that happens all day, every day, where people are hiring generalists to do specific searches. And look, not that you can equate business to health, but man, these are mission critical roles within private equity where an expert is really required, but yet I'm hiring a generalist. Why would you do that?
Why would you? I mean, look at it another way, just with the math, right? A generalist may have done, I don't know, 5 CFO searches last year, right? So, okay, that's good. Place some CFOs, that's great. But, Caitlin on our team is in the market all day, every day for CFOs. She knows who's available. She knows what it's going to take to get them. And she knows exactly who's moving where at all times. There is no other person in the industry at another firm that understands it to the level that Caitlin does. Why would you work with anyone else?
It makes no sense. But I think, look, if we wrap this up with what does this mean for PE, get ahead of the market. And I always talk about this example of we get called 6 months after there was no need. And so to me, getting out of the market, as soon as you have an inkling that you either need to replace the role, hire a new role, give us a call. The second thing is work with specialists, people that really know the industry, know the market, that can get the best candidates on the line, anticipate who's going to be available, and get them ready to take your role. I think it's working with a firm that has skin in the game on success fees. And then, of course, call us in during due diligence. We work with a number of our top clients as soon as they identify an asset that they think they might want to hire, to give them a view on the talent market. So those are things that the PE firms can do. But the final thing that I kind of want to wrap up with is what people can expect from Bespoke in 2025, because we've got a number of exciting things on the docket. But I think first and foremost, right, we are going to stay in our knitting. So our professionals are going to stay focused on what they do best: software and functional expertise. And we're going to continue to do that because that drives outsized value to the market. The other thing that we're going to continue to do is monitor capacity. So when the market swings back, we're not going to tax our professionals. We're going to keep them, our recruiters, at that 6 searches per recruiter fashion, because at the end of the day, our reputation resides on success, our last search, and our ability to do that. So we're not going to sacrifice quality. The other thing that's unique to us, which I still boggles my mind, 90% of the search firms in the industry pay their partners an outsized fee to sell work. We don't pay our partners to sell work at all. It's executing work. Our partners only get paid when they solve searches. And so we're going to continue to do that, which is going to translate into great results. But Boone, the other thing that's really exciting about 2025 is our executive index. Can you talk a little bit about this software executive index and what that's going to mean for the industry?
It's a game changer. It's going to turn the industry absolutely on its head. The executive index, while we haven't talked a lot about it publicly yet, we're going to here in a couple of months with a major launch around it. But the executive index is the most authoritative information on 700,000 software executives in the United States. Anybody who's ever done anything that's relevant to growing a software company and helping private equity firms to achieve their investment thesis around a software company is in our executive index. And it uses AI and hundreds of data sources to validate every aspect of these people's backgrounds. So we're actually able to validate and confirm the accomplishments in their career and how they were able to grow different companies in different ways, and just about every aspect of them. It is going to be an absolute game changer. There is nothing else in the industry that is like it. And our clients are going to have the benefit and the access of better visibility of software executives than anyone else. This is going to allow them to get well ahead of their competition in securing the best talent.
No doubt. Very excited for that. Excited for 2025. A lot of optimism around increased deal flow, increased exits. So Boone, cheers. Appreciate you coming on to talk about 2025. Look forward to seeing how it unfolds.
Absolutely. Me too. Thanks, Eric. Really enjoyed the discussion and looking forward to what 2025 has to offer.